Look, I've been studying markets for 35 years. I ran hedge fund sales at Goldman Sachs. I've managed money at GLG Partners. I've called the 2008 financial crisis, the 2012 European sovereign debt crisis. I've seen every institutional trap, every engineered flush, every manipulation play that exists. And what's happening to silver right now is one of the most perfectly constructed traps I've seen in my entire career. Silver hit $121 per ounce in late January, then it crashed 36% in a single day, and now it's sitting around $77 while mainstream media tells you the bull market is over, that the bubble popped, that silver was speculative frenzy and now reality has set in. I'm going to show you today why every single word of that narrative is wrong, why the dip is the trap, why the structural forces driving silver are stronger today than they were when silver was at $121, and why February 27th, 11 days from now, is the date that changes everything. Because here's the number the mainstream media isn't telling you. The March 2026 COMEX silver contract represents 528 million ounces of delivery obligations against only 98 million ounces of registered silver available for delivery. That's more than 5 times the deliverable supply in a single contract month. And February 27th is first notice day, the day contract holders must declare whether they want physical silver or cash settlement. Subscribe now, because what I'm about to explain is why the people who sold silver at $77 are going to look back at this moment in complete disbelief. Part 1. What actually happened? The engineering of a crash. Let me explain what actually happened when silver crashed, because the mainstream narrative is designed to deceive you. The media says silver got overheated, that retail speculators drove it to irrational levels, that the market corrected. That's the story. Now, here's the data. The CME Group raised margin requirements to 60% in a series of rapid hikes while silver was surging. What does this mean in practice? If you were holding silver futures with borrowed money, you suddenly needed to wire in massive amounts of additional cash within hours, or your position would be automatically liquidated. Most retail traders don't have that cash sitting idle, so they got forced out. Their positions were automatically sold, and that selling created more selling, and more selling created more margin calls, and more margin calls created more forced selling, a cascade engineered by the exchange itself. This is the same playbook they've used for decades. They did it to gold in 2011. They did it to silver in 2011. They do it every time a commodity threatens to break free from paper control. But here's the detail that exposes the manipulation. While futures prices were crashing nearly 40%, silver mining stocks only pulled back 2025. Think about that. If the bull market was genuinely over, if the fundamental case for silver had collapsed, mining stocks would have crashed just as hard. They didn't. Why? Because the people who operate silver mines and understand physical supply better than anyone on earth didn't believe the crash. They held because they know what's in the ground, and they know what's in the vaults, and what's in the vaults is running out. Part 2. The COMEX math. Why IT doesn't work. Let me show you the math that the financial media refuses to discuss. COMEX registered silver, that's the metal actually available for delivery against futures contracts, has collapsed. As of February 11, 2026, registered inventory fell below 100 million ounces for the first time in years. In a single week in early January, 33.45 million ounces were withdrawn. That's 26% of registered inventory vanishing in 7 days. The drainage rate has accelerated to approximately 785,000 ounces per day. Now look at the March 2026 contract. Open interest, 8500091000. Contracts. Each contract, 5,000 ounces total exposure, 425455 million ounces available registered silver. 98 million ounces, even if only 20% of contract holders demand physical delivery, which is conservative given what we saw in February. COMEX would need 85 minus 90 million ounces. It doesn't have. The math doesn't work. It can't work. And February 27th is the day the market has to confront that math. This is what I call the paper to physical disconnect. The futures market has been setting silver's price based on paper contracts, but paper contracts only work as price-setting mechanisms when physical delivery is credible. When physical delivery becomes questionable, the entire pricing mechanism breaks down. We're watching that breakdown in real time. Part 3. The physical premium. The market is already speaking. Here's something most people haven't connected yet. Even while the paper price was crashing to $77, physical silver in Shanghai was trading at $15.20 above the paper price. The paper market said $78. The physical market said $95.100. One of those markets is lying. You cannot fake a silver bar sitting in a vault, but you absolutely can fake a futures contract. The Shanghai premium is the market telling you that physical silver is worth more than the paper price suggests. Industrial users in Asia, the people who actually need the metal, are paying significant premiums because they understand the supply situation. This is the same pattern we've seen at the end of every commodity manipulation. The physical market eventually overwhelms the paper market, and when it does, prices don't correct, they explode. Let me tell you about someone I know. I'll call her Catherine. She's 58, been following the silver thesis for 18 months. She understood the supply deficit. She understood COMEX dynamics. She had a meaningful position in physical allocated silver. When silver hit $121, she felt vindicated. She called me thinking about selling half to lock in profits. I told her to look at the delivery data first. She did, and what she found stopped her cold. January deliveries were 7 times the January 2024 level. The drainage rate from COMEX vaults had accelerated. March open interest was building 2 levels that made available inventory look like a rounding error. She held. Then the crash came. Her paper account value dropped dramatically. She called me in genuine fear. I told her, Catherine, look at the physical premium. Look at what Shanghai is paying. The paper market said $78. The physical market said $95,100. One of those markets is lying. She held her physical silver. Within days, the recovery began. Don't be the person who sold the physical to chase the paper price. Part 4. The new demand revolution: solid-state batteries. Now let me show you why the demand side of this equation is about to transform completely. On January 16, 2026, Stanford University published research in Nature Materials demonstrating that a nanoscale silver coating can solve the cracking problem that has plagued solid-state batteries. Silver-treated solid electrolyte surfaces become 5 times more resistant to lithium intrusion damage. The implication is staggering. Current lithium-ion EVs use 25–50 grams of silver per vehicle, mostly in electronics, not in the battery itself. Samsung's solid-state batteries using silver-carbon composite anodes could require approximately 1 kilogram of silver per 100 kilowatt-hour battery pack. That's a 20–40x increase in silver content per vehicle. At 50% solid-state battery adoption, automotive silver demand alone would exceed current total industrial demand. Let me repeat that. A single application EV batteries could consume more silver than all current industrial uses combined. This isn't theoretical. Samsung is partnering with BMW for evaluation vehicles in late 2026. The timeline is real, the demand is real, and the silver that feeds it doesn't exist in the quantities required. The global silver market has been in deficit for 5 consecutive years. Mine production is around 8–0850 million ounces. Total demand exceeds 1.1 billion ounces. We're drawing down above ground stocks every single year. Now add a potential order of magnitude increase in automotive demand. The numbers don't work, and the market hasn't priced this in yet. Part 5. China's strategic positioning. Now let me tell you what China is doing that should concern every Western investor. China classified silver as a strategic asset on January 1, 2026. Export restrictions are in place. Only 44 companies received authorization to export silver through 2026 and 2027. China represents 60–70% of global refined silver supply. But here's the part most people haven't connected. China knows the COMEX is under maximum stress heading into February 27th. They know Western physical supply is critically tight. They're not going to trigger a COMEX default directly. But they are positioned to benefit enormously when the paper market loses its ability to set the physical price, when the paper price collapses due to forced margin liquidations. But physical silver in Shanghai trades at $20 above spot. China sits on the largest strategic silver reserve in the world. They're not panicking. They're patient, and February 27th is their moment to step in on their terms. This is exactly the kind of strategic positioning I've seen before in commodity markets. Patient accumulation during paper-driven weakness, then strategic leverage when the physical market reasserts control. Part 6. The US government is competing. Here's something that should tell you everything you need to know. The United States government just added silver to its critical minerals list and launched what they're calling Project Vault to stockpile critical minerals. You don't take those steps when a commodity is abundant. You take those steps when you're looking at a supply crisis and trying to get ahead of it. The US government is now competing for physical silver. At the same time, Sprott Physical Silver Trust announced it has doubled its capital raise program to $2 billion to acquire physical silver bullion. $2 billion at current prices represents approximately 18 million ounces of physical silver. That's roughly 16% of current COMEX registered inventory. One institution, one capital raise, 16% of deliverable supply. And they're not the only buyer. Central banks are accumulating, industrial users are hoarding, and the paper price is telling you silver is worth $77. Once you see the disconnect, you can't unsee it. Part 7. The three scenarios. Let me give you the framework for what happens on and after February 27th. Scenario 1. Managed delivery crunch. COMEX manages the delivery crunch by converting eligible silver to registered silver and preventing a technical default. The paper price stabilizes, but physical premiums expand dramatically because industrial users still can't get metal at paper prices. The paper market survives in form but loses its function as the price-setting mechanism. Silver reprices over months as the market discovers what physical metal actually costs. Scenario 2. Another margin hike. COMEX raises margin requirements again before February 27th, exactly what they did in December to trigger the crash. The paper price crashes again. Physical holders who understand the thesis accumulate more physical metal at artificially low prices. Industrial demand continues growing regardless. The paper price eventually catches up to physical reality. This is the trap within the trap. They engineer lower prices. Smart money accumulates. Then, the squeeze. Scenario 3. The funeral of COMEX. Delivery demand exceeds what the exchange can manage. Force majeure is invoked. Cash settlement is imposed. Paper contract holders receive dollars, not silver. The paper price becomes irrelevant. Physical silver commands a massive premium permanently. The two-tier market becomes the new normal. In all three scenarios, physical allocated silver is the winning position. In scenarios 2 and 3, it wins dramatically. Part 8. The everything. Code connection. Now let me connect this to my broader macro framework. I talk about the everything code, the idea that liquidity driven by currency debasement is the master variable that moves all asset prices. Governments are expanding money supply at 8% per year. Add 3% measured inflation. That's an 11% hurdle rate just to maintain purchasing power. Silver has returned 170% plus in 2025. Why? Because it sits at the intersection of three massive forces. Currency debasement. Silver is a monetary metal. It's been money for 5,000 years. When fiat currencies are being debased at 8% annually, hard assets rise. Industrial demand explosion. Solar panels, EVs, AI infrastructure, data centers all require silver's unique conductivity properties. Supply constraints. You can't print silver. Mines take 10 plus years to develop. Supply growth is structurally limited while demand is exponentially expanding. This is the perfect setup for what I call a super-massive black hole, an asset that absorbs capital because the math forces it. The paper manipulation is trying to fight this tide. It can't win. It can only delay. And February 27th is when the tide overwhelms the manipulation. Part 9. The action framework. Let me give you the action framework for the next 11 days. First, if you sold silver during the dip, understand that you may have sold into an engineered trap. The structural thesis hasn't changed, it's gotten stronger. The question is whether you want to rebuild your position before February 27th or after. Second, if you still hold physical silver, hold it. The paper price dropping $277 doesn't change the fact that you own real metal that industrial users desperately need. The physical premium over paper price is your real return signal. When physical premiums surge, that's the market telling you the paper price is fiction. Third, if you're looking to add to your position, watch the premium data more than the spot price. When physical silver is available at or near spot price, that's your window. When premiums start expanding again, the window is closing. Fourth, move away from ETFs toward physical allocated metal. The January crash proved that paper silver can be driven to whatever price the exchange wants through margin hikes. Physical silver cannot be margin hiked. It exists or it doesn't, and right now it's running out. Fifth, February 17th is Chinese New Year. Physical buying from Asia pauses for approximately 7-10 days. That pause, combined with continued drainage of COMEX vaults, means the window before the next surge is narrow. When Asian buying resumes after the holiday, it collides with February 27th delivery pressure. That collision is the setup. Part 10. The DFU framework for silver. Now let me apply my DFU framework. Don't F this up specifically to silver. Don't use leverage on silver. The margin hikes are specifically designed to liquidate leveraged positions. If you're leveraged, you're a target. You will be forced out at the worst possible moment. Physical silver cannot be margin called. That's the whole point. Concentrate on quality. Physical allocated silver, not ETFs, not futures, not mining stocks for the bulk of your position. Mining stocks can work as satellite positions, but the core holding should be metal you own and can verify. Set it and forget it. Don't check the paper price every day. The paper price is designed to shake you out. Focus on the physical premium. Focus on COMEX inventory. Focus on delivery data. These are the real signals. Ignore the noise. The mainstream media exists to keep you on the wrong side of trades. Their job is to explain why you should sell at the bottom and buy at the top. Inverse them. Here's what I want you to understand about this moment. The dip was engineered. The narrative that the bull market is over is false. The numbers tell a different story. 528 million ounces of delivery obligations. 98 million ounces available and falling by nearly 1 million ounces per day. The US government adding silver to its critical minerals lists, doubling its capital raise to acquire physical silver. Stanford research showing solid-state batteries could require 1 kilogram of silver per EV. China sitting on the world's largest silver reserve with export restrictions in place. These are not the characteristics of a commodity whose bull market is over. These are the characteristics of a commodity in the final stages before a structural repricing that mainstream markets haven't priced in yet. The dip is a trap. February 27th changes everything, and the people who understand what's happening are accumulating physical silver right now while the crowd is reading headlines about the bubble bursting. Look, I've seen this pattern before, in 2008 with credit, in 2020 with Bitcoin, in 2025 with gold. The mainstream narrative tells you one thing, the data tells you another. The data always wins eventually. The only question is, which side of February 27th do you want to be on? Subscribe, share this with someone who sold during the dip and needs to understand what actually happened, and check the link in the description for my full framework. The trap has been set. The question is which side of it you're on.